Let's get started with the Module 3, Reinsurance Accounting Basics in Crack Your Interview, General Insurance Accounting Series. Topics to cover in this module. What is reinsurance? Simple definition and purpose. Types of reinsurance: proportional versus non-proportional. Reinsurance lifecycle overview. Accounting entries. When premium ceded. When claims recovered. Reinsurance benefits for insurance companies. P&L impact and matching principle. Interview tip: how to explain reinsurance with clarity. Let's start with the most important question. What is reinsurance? Reinsurance is insurance for insurance companies. It allows insurers to transfer part of their risk to another company, called a reinsurer. This helps protect the insurer from large losses and improves financial stability. Let's understand the reinsurance lifecycle from start to finish. It begins with ceding the risk. The insurer transfers part of its risk exposure to a reinsurer through a treaty or facultative agreement. Next is the premium payment. The insurer pays a share of the premium to the reinsurer for taking on the risk. Then comes the monitoring phase, where both parties review claims experience, treaty conditions, and exposures periodically. When a claim arises, the insurer pays the full claim and then files for the reinsurance recovery based on the agreed share. The reinsurer reviews and, if valid, settles the claim by reimbursing the insurer. Finally, regular accounting and reconciliation ensure the books match, tracking premiums ceded, recoveries, and commissions. There are two main types of reinsurance: proportional and non-proportional. In proportional reinsurance, the insurer and reinsurer share premiums and claims in agreed ratios. For example, a 50-50 proportional treaty means both share half the premium and half the loss. In non-proportional reinsurance, the reinsurer only pays if the loss exceeds a certain threshold. This is also called excess of loss coverage. Understanding this distinction is key to how risk is distributed. Let's take a simple proportional reinsurance example. An insurance company writes a policy with a $1,000 premium and a $100,000 sum insured. Under a 50% quota share treaty, the reinsurer receives 50% of the premium, that's $500, and covers 50% of any claims. If a claim of $20,000 occurs, the insurer pays $10,000 and the reinsurer pays the other $10,000. This shows how proportional treaties equally share risk and premium. Let's look at the journal entries under a proportional treaty. When the insurer earns the full premium of 1,000 Indian rupees, they record it as income. Next, they cede 50% to the reinsurer, 500, recorded as a reinsurance expense. If a claim of 20,000 Indian rupees occurs, the insurer records the full claim as an expense. Then, they recognize the reinsurer's share 100,000 as a receivable under reinsurance recoverable. This accounting ensures correct matching of premiums, claims, and reinsurance effects. Non-proportional reinsurance, example. Let's look at an example of non-proportional reinsurance. Assume the insurer has an excess of loss treaty with a retention of $100,000 and a coverage limit of $400,000. Now, imagine a major claim arises for $350,000. In this case, The insurer pays the first $100,000, which is their retention. The reinsurer covers the remaining $250,000. This type of arrangement protects the insurer from large, unexpected losses without sharing every small claim. It's commonly used for catastrophe cover or large risk portfolios. Slide 9. Let's understand non-proportional reinsurance with a simple example. In this type of reinsurance, the reinsurer covers losses only above a set threshold, called the retention limit. Suppose an insurer has a stop-loss reinsurance agreement where it retains the first $100,000 of losses, and the reinsurer pays anything beyond that. Now, a large claim of $250,000 is reported. The insurer will bear the first $100,000. The reinsurer pays the remaining $150,000. The journal entry for the reinsurance recovery is Dr. Reinsurer receivable $150,000. CR claims recovery income $150,000. This records the receivable from the reinsurer for their share of the loss. Remember, in non-proportional reinsurance, the reinsurer doesn't share premiums proportionally. They step in only when losses exceed the agreed threshold. Let's explore how accounting works in reinsurance. When an insurance company cedes a portion of the premium to a reinsurer, it needs to record this transaction. Here's a common example. A general insurer earns a gross premium of $100,000. It cedes 30% to a reinsurer, that's $30,000. The accounting entry will be debit, reinsurance premium ceded, $30,000. Credit, reinsurer payable, $30,000. This shows that part of the premium is being passed on to the reinsurer. Now suppose a claim of $50,000 is incurred, and the reinsurer covers 30% or $15,000. The accounting entry would be debit, reinsurer receivable, $15,000. Credit, claims recovery income, $15,000. This reflects the insurer's right to recover part of the loss from the reinsurer. Proper reinsurance accounting ensures that the insurer's books show only their net exposure, not the gross risk. Accurate tracking of ceded premiums and recoveries is essential for solvency, compliance, and profitability analysis. Let's explore reinsurance benefits for insurance companies. Capital relief frees up capital by transferring risk. Solvency protection helps insurers stay solvent during large-scale claims. Underwriting capacity allows insurers to take on bigger risks. Risk diversification shares exposure across reinsurers globally. Profit smoothing. Reinsurance reduces claim volatility in financials. P&L impact and matching principle. Reinsurance premiums are treated as expenses. Claim recoveries reduce gross losses. Matching principle. Reinsurance recoveries are matched with claim events to reflect accurate profit loss. Interview tip. Reinsurance helps insurers maintain stability. I always explain it as a risk-sharing partnership. Matching principle ensures profits reflect actual performance. Wrap up. Next topic: facultative versus treaty reinsurance. CTA. Subscribe and watch the next part.